Danny, I want to start with you first. Why exactly is this crunch time? The Greece's bailout doesn't actually expire until June 30th. And if the last 6 years have taught us anything, it's that nothing gets resolved until the last possible minute. So we still have, what, 11 business days, 15 actual days, don't we?
No, we do. We have some time to go, and this is obviously political posturing on both sides. But the reality, and I've said this to you several times over the last few years, the reality is Greece is in the situation of can't pay, won't pay, and what's been imposed on them the last 5 years has generated a terrible recession. Output's down 25% since the start of 2010. So it's hard to see how this actually gets resolved without a really major give on the part of the creditors, which doesn't seem to be coming, or exit. That's really the choices on the table.
Well, I think for the stock market, the big issue here, it's very difficult to make a one-to-one connection between a Greek exit and U.S. stocks. Why would you sell Apple today because Greece is going to exit the euro? But talking about the euro and connecting the dots in between, I think, is what really has people spooked out. For example, I haven't seen, maybe you guys have, but I haven't seen a really good forecast of what would be a fair exchange rate for the euro if Greece leaves. I don't think anyone can say with any confidence what that is. And so the knock-on effects from that, you know, as far as S&P 500 earnings, as far as
Danny, the euro would trade higher in theory if Greece leaves and if
the euro would trade higher.
Spain were to follow.
And obviously there's an issue of short-run chaos. But then maybe for Greece, after that short-run chaos and capital flows come, they actually have a rescue package which is called a depreciated drachma. So that's really the question for Greece. Is there an advantage in the medium to long term of putting up with this short-term chaos? And they really do have a hand. I mean, the problem for the ECB and the creditors is, what if Greece leaves and does pretty well? That really makes the whole sort of Eurozone project much more fragile because it gives incentives for other people to leave. So Greece can actually use this as a trump and say, well, supposing we do well, that really puts you in trouble. That's part of their bargaining hand.
Well, we might be getting a little bit ahead of ourselves there and projecting out that Greece might be okay. But earlier this month, Mario Draghi said that investors need to get used to volatility, especially in the bond market. He's going to be testifying before the European Parliament today. Has the ECB provided enough cover for the European economy that a Grexit would have a limited contagion effect, as people seem to be pricing in?
I don't think we really know. I mean, the arguments clearly are that it's better than it was in the past, but I think we've always underestimated the risk of this kind of action. I mean, there's a lot of unknowns here, so my view would be the risks clearly to that are to the downside. Let's hope that they have done that, but clearly it raises risk premia. The potential is, and your other commentators are right, it's hard to quite understand why Apple stocks are moving on the basis of what happens in Greece, but this is just about volatility and uncertainty, and we really don't know whether there's enough backstop there. The suspicion probably is that there is not.
So there's more vulnerability for something like the German stock market. I know we've been writing about how German stocks are in correction mode and could easily fall into a bear market.
Right. Gina Martin-Adams at Wells Fargo had an interesting note this morning looking at the contagion aspects, especially credit default swaps on Spain, Italy, their bond yields. They, as you said, they really hadn't shown much contagion. But this morning, that's starting to look differently. They're starting to blow out a little bit. And especially the ECB has said that they were going to sort of dial back their bond purchases in the summer months. And with that coming up, it does make you wonder if they'll, it'll force their hand to sort of, add to those bond purchases in the summer, or, could we see another contagion effect like we saw a few years ago with spiking bond yields outside of Greece?
Danny, quickly before we go, is this game theory in action?
Well, Varoufakis, the Greek finance minister, is an expert in game theory, and I think he's been trying to play those cards. I mean, what we know here, as a commentator again said, your action depends upon my action, which depends, and the thing continues. So yes, this is going down to the wire, but I don't think people should underestimate the fact that Greece actually has cards to play. Wolfgang Munchau today says if Greek defaults alone, that would mean 160 billion euros of losses to France and Germany. So obviously they need to protect that. So this is game theory in action, but it isn't over till it's over. and
All
it's
right.
not over.
It's not over yet. All right, Danny Blanchflower, thank you so much. Dartmouth College professor and our own Mike
Thank you.
Regan, Bloomberg News stocks editor at large.